It's going out there. It's Wednesday, June 22nd. I'm Frank Curzio. It's the Wall Street Unplugged podcast where I break down headlines and tell you what's really moving these markets. It's Wednesday. I bring in my buddy, Daniel Creech. Seems like a while since we did podcasts together, right? I mean, I don't know. Did we go back.
Week? We go back and forth. Yeah.
I don't know.
You're traveling a lot. I was traveling a lot. But it's Wednesday. Wednesday's the best day of the week. It's great to be here.
Why is Wednesday the best day of the week?
Because you and I are on here talking about stuff that moves markets, you know?
That's a good answer. I like that.
I gotta like this.
Anyway.
Wednesday's the middle of the week. There's a lot of good things with Wednesday. The week's coming to a close, you know? Everybody that's like working different hours, like BS, my week's just started.
I know, right? And not to mention that we had Monday off to a brand new holiday, which is cool. Yeah. I won't get into that. But I talked about that a little bit yesterday. But anyway, I wanted to start off with asking you, by the way, Daniel's a senior analyst at Curzio Research. I want to start off by asking you a very simple question, because it seems really difficult for people out there. Are we going into a recession or not?
Yes. Next question, Frank.
Okay. Now let's move on to... I mean, the talk of recession, and today have Powell on the stand, and they're ripping him apart, telling him how shitty of a job he did. We already know. I hate that they talk about the past. It's like, let's talk about the future. What are we going to do to help inflation? But on the recessionary front, I want to highlight of what the big banks are saying, because this is important, right? So first of all, a recession is defined by 2 straight quarters of negative GDP. We had one last quarter. It's probably not going to be this quarter. So we're not going to have an actual recession, a definition of recession probably this year, but a lot of people are predicting in 2023 and 2024 when we see 2 straight quarters of negative GDP growth. With that said, Citigroup raised their odds. They say they see a 40% chance of recession. Deutsche Bank sees a 40%. Goldman's 48%. Evercore sees no inflation. And the Wall Street Journal survey of top economists, which was published only 3 days ago, Daniel, shows that there's now a 44% likelihood of recession in the coming 12 months, where in May it was 30%. So you're getting these surveys everywhere. And I find it kind of funny, right? I mean, it's just, to me, it amazes me that we're placing so much emphasis on this one data point. And just to put this in perspective, in December 2007, the Wall Street Journal survey that just said 44% likelihood of recession. So in December 2007, the month preceded 2007-2009 recession, that's when it began, economists assigned just a 38% probability. In February 2020, that was the last recession, they assigned a 26% probability. And I'll give them a little bit there because, we locked down everything, which is going to go down as probably the biggest mistakes we've ever made in our country's history, as we're seeing right now with the money printing, the labor shortage, supply chain shortages, the health effects of everything. Probably the worst thing as a country we ever did, and the dumbest thing we've ever did, which we're realizing. I don't think you could argue that or debate that. Anyway, but to put this in perspective, when the Wall Street Journal surveys these top economists and they say 44%, Daniel, and their highest rating is usually at 38%, this is saying there's a 100% chance of recession. 100% chance, right?
Yeah, absolutely. And we've joked about this for some time now, because this is just the perfect illustration of the difference between government data and or any data that you must take with a grain of salt and reality. To your point, technically, definition, 2 negative quarters back to back, we're not going to hit it. If we come in at 0.1 or whatever, and we're technically not there, is it too easy to just harp on everybody, Frank, and talk about how out of touch everybody is that is supposedly the smartest people in the room? Because if you ask your regular folk like me and you, does it feel like you're in a recession already? If this isn't a feel like, what is? Is it $8 a gallon instead of $5 for gas? Is eggs and meat going to continue to go up? Do they have to go up another 30% from here to make it feel worse? Remember last year, the administration had a great time pointing out that the 4th of July cookout was 16 cents lower than previous year. That was a big savings. That goes again with a great idea of the gas tax holiday, which would only lower prices by roughly 3.5%. We'll get into that in a minute.
Yeah,
but the back and forth, I think it's good for this reason. I think your average Joe who is starting to, and I don't have anything against average Joes. I love the Joe Walsh song, Ordinary Average Joe. That's me. I think it's good for the sense of, unfortunately, it takes pain for people to pay attention to certain things. We do our best to make economics and politics entertaining, to pay attention to how to make money and profit. But it's a tough uphill climb because it's not always exciting. You gotta try and do your best. But when markets drop 30%, Frank, even the guy that doesn't really give a crap about money might start to pay attention. right? Because now you're starting to feel it in the economy. And what I hope that comes out from all this is that you see Janet Yellen recently, a couple days ago, says she doesn't think recession is at all inevitable. You go back and forth between banks and when it's going to happen and all that. I think it's good because it only highlights the out of touchness that our quote unquote smartest people are. And I think people will take more interest in their own. And I think that's good for the long term. It's very painful in the short term, but I think it's great for longer term investors.
You know, as I put on CNBC and I see these politicians, I see the Fed, and then I see just UBS saying we don't see a U.S. or global recession in 2022, 2023. Yeah, the Congressional Budget Office, and this is last month. This is recently, a couple weeks ago. They said real GDP, they're expecting at 3.1% in 2022, 2.2% in 2023, then 1.5% in 2024. Inflation, based on the CPI, they're expecting to end the year at 4.7% in 2022. Good luck with that. And then in 2023 and 2024 to go back down to 2%. The unemployment rate to be below 4% for the next 3 years. The Fed funds rate to only go up to 1.9% in 2022. Maybe you're right there. Actually, you're not going to be right there. So it's going to go a lot higher than that. And 2.6% in 2023. This is a month ago. So when I look at this, all I see is bullshit. Like, it's such, like, I think they look at people like the average Joe and say, hey, these guys are such fucking idiots. They're not going to know the difference anyway. So let's just say whatever the hell we want.
I agree with that.
Midterm elections coming. Like, so let's grandstand, because recession is a word that everyone identifies with. In our line of business, we could say we all feel like we're in a recession right now with the NASDAQ down over 30%, Bitcoin down 70%, most of your assets coming down, home prices coming down. I mean, I can keep going and going and going. I mean, you're seeing net household wealth actually is lower year over year for the first time. That's a signal of recession. Everything spells recession right now. Yes, there's some highlights where earnings are staying up pretty strong. Believe it or not, earnings, and people don't know this, but earnings for S&P 500 are expected to grow year over year, which is insane. Think about what's going on right now. So that means a lot of these guys have not lowered their estimates low enough. But, you're seeing bank loans rise. So, there are pockets that are okay, and home prices staying a little bit firm. They are starting to come down a little bit because there's low supply. But, mortgage rates, of course, you're seeing mortgage demand for lending is coming down with rates higher. But they look at the average person and say, these people are just going to believe whatever the hell we say. And we've gotten in trouble a lot by just really digging in and doing the research, Daniel, and going to different places and seeing it during COVID, during fracking, during different things, and getting ripped apart because people just watch TV and believe everything they hear. But to see these assholes on TV just saying, oh, it's a 44%. I mean, no one has higher than really a 50%. I think Goldman's a little bit higher than, no, Goldman's at 48%. We're fucking going to recession. The Fed is forcing a recession. They have to force a recession. They have to raise interest rates. We've been saying this for 12 months, right? And then finally, for 18 months. But once they started raising rates, they have to force a recession. They take money out of them. All this massive leverage, which is in trillions out of the market. So they have to force a recession because inflation keeps going higher and higher. And they don't know what to do about it. They're confused. So the whole recession and trying to avoid the actual word recession heading into midterm elections, I get. But as an investor, like you said, Daniel, look, I'm not telling you not to buy stocks. I'm not telling you it's not going to get worse because it's going to get a lot worse. But you have to look at what's going on, where you're seeing that 30% decline in NASDAQ. You're seeing that the average PE ratio right now, the average PE for the S&P 500 is trading at 15 times, which is lower than the 5-year and the 10-year on average in history. And maybe those earnings come down. We saw more companies lower earnings than any other point, I think, since 2009 or 10. So you're seeing that come down. But you look at Walmart, Target lowering their prices, M2 growth slowing from 27% year over year to up 6%. I mean, you're seeing it in global yields. You're seeing the bond market crash. It's, to me, when I see shit like this and all the bullshit, it actually pisses me off. But it pisses me off personally, but I want you to use this to your advantage because you're looking at small caps trading at their cheapest level almost in 25 years. You're looking at money starting to slowly pour into. You look at insider buys through the roof. And again, I'm not saying it's not going to get worse or you're not going to get hit 10, 15% from here. But I do know in 2 years from now, it's going to be a lot higher because inflation is going to crash. It is going to crash. It's probably going to happen a lot sooner than expected. I mean, you're seeing it right now. You're seeing it in different pockets where home prices are coming down, the Walmart, the Targets. Again, the M2 growth has slowed dramatically. And a lot of this is priced in. So if you're looking at stocks and saying, holy shit, inflation's out of control, it's been out of control. And that's why the stocks are down 30% plus. And a lot of stocks in your portfolio are down 50, 60% if you bought SPACs and a lot of shit. So you have to look at it that way. You can't signal the same exact risk going on and say, okay, you have to look at everything that's happened since then. And now for me, seeing companies raise their dividends, you're looking at oil stocks really freaking getting destroyed, down 20, 25%, some down 30% in the past 2-3 weeks. That was the point. Everybody was pouring money into there thinking everything's okay. But when it comes to recession, guys, ignore the bullshit. Just say, okay, we're in a recession. How am I going to benefit? It's going to probably result when you say the word recession, maybe stocks come down a little further. It's going to be like this fear factor. But man, there is a lot of stocks that are trading below 10 times earnings. I covered it yesterday of the game plan. China is starting to grow again. I'd start looking at China, maybe an ETF there. Small caps, again, more companies in history are trading more cash than market caps are in history. They hit 10%. That's in history. That's not in the past few years. That's more in COVID. That's more in, in tech bubble burst in 87 in history. So a lot of this is being priced in. And again, it could get a lot worse, but all the measures that the Fed's putting in place is doing everything they can, and it will result in inflation coming down because people aren't going to be able to afford these crazy prices. And now it's looking like safe havens, like oil, are also getting hit. Now, is that going to stay that way or not? And you've been covering the oil industry a ton and reading everything, dang, about the oil industry. But, what's going on there? Would you tell people to invest in these companies? They're increasing their dividends. They're reporting massive earnings. But yet, you're just seeing this transition as maybe I should lighten up on oil over the past couple of weeks.
I think that the pullback in oil right now is a good entry point if you want to look to add exposure or if you don't have any exposure yet. I think the only better, I'm going to mess that up, Frank. The only better opportunity on a pullback would be a ceasefire announcement between Russia and Ukraine, which I don't foresee happening very soon. I was dead wrong on that. I've bought into what they were telling you.
It'd be positive for oil or negative for oil prices?
I think it would be...
Like oil prices go up on that or down?
No, I think they would go down, which would mean that would be the only better entry point because I think you'd get a pullback. If you have an announcement of a ceasefire, I think everything would pull back and that would be a good time to get in because the logistics and the inner workings are not fixable just because, like, your supply and demand isn't going to balance just because of Russia. So, for instance, let's say Russia and Ukraine announce tomorrow that they have a ceasefire. Well, if the world governments followed through and 24 hours later, which they never do anything that quickly that would amount to anything, but if they followed through just 24 hours later and removed all sanctions, how long does that take to get through the pipeline and all that kind of stuff? Not going to happen. So I think that this is a good one. If you don't have any exposure, you want to increase it for a couple of reasons. One, remember the Panama Papers leak, Frank? We need to come up with a marketing tool about the Chevron papers or the oil letters or Biden's oil diary or something like that, because there's a saga of, sitcom saga basically going on between, unfortunately, the most powerful industry, in my opinion, energy, and the governing superpower of the world, the United States government. Have you been following this back and forth at all, Frank?
Yeah, I have. It's the reason why Exxon and these guys are really coming out because they're really pissed off at what, the president is saying and saying that it's kind of their fault. It's all their fault. And they're like, F you, basically. So
earlier in June, which is now making much more sense. And we're going to talk about the guy behind the scenes here because unlike I believe that Buffett, I'm giving it away, that President Biden is doing everything on his own, I don't think the Chevron CEO is acting independently, and I like it a lot. A couple of weeks ago, early June, the CEO of Chevron did a sit-down interview with Bloomberg, and he said some pretty wild stuff, Frank. Do you know where I'm going with this? He used the word never.
Yeah.
You know what I'm talking about? Well, now I got to get the quote in front of me because I don't want to exaggerate this claim because it's important. He was talking about the two things you hear most about are drilling and, hey, the administration's going to say we got plenty of leases that are open to drill. Oil companies just are being greedy. They're not drilling. They're gouging the customers. Oil companies come back and say the leases you quote, they're not near half that. They're still tied up in litigation, permitting, all that kind of stuff. That's a big difference between getting oil out of the ground and getting it refined to where it goes into something like your gas or your truck or your car or your boat or whatever. So the Chevron CEO was calling out the administration, and he says that there hasn't been a refinery built since the 70s. Did you know that, Frank? I wouldn't have guessed that.
I knew that.
I would have hoped that it would have been a little bit better than that or recent than that.
Yep.
He also said that he doesn't project another one to get built in the U.S. Why? Because these are multi-year, multi-billion-dollar investments. And when you have a political organization or group of people that happens to be in power, and this is a quote from the Chevron CEO, at every level of the system, the policy of our government is to reduce demand, So it's very hard in a business where investments have a payout period of a decade or more, and the stated policy of the government for a long time has been to reduce demand for our products. Why would you invest over a decade, billions of dollars, when you know they're trying to get rid of your products for energy usage? So that's a huge thing, okay? This was a couple weeks ago he did this. And I think it was because he knew it was coming when then the Biden administration writes a letter to all the oil executives, calls them greedy, blames them for everything, and says, just like a light switch, Frank, you need to increase your capacity for refining and get more gas out there available to consumers. Well, you don't have any new refineries being built. And even if they started breaking ground today, who knows how long that would take to get online. And B, the existing refineries that you have that have tried to be expanded and or developed further run into policy permitting, environmental concerns, and all that. Not that any of that is not important, but it really holds back the desire here to really be energy independent. Frank, what is key about Chevron stock out of the other major oil companies when it comes to shareholders and influence?
It's Buffett, right?
Buffett's
in there. Yeah.
Buffett owns what? 8% of Chevron?
Does he own that much? I don't know.
I believe it's 8%. Yeah. That was according to Capital IQ when I checked the other day. Now, if I'm the CEO of Chevron, I'm going to call Mr. Buffett and I'm going to ask him, hey, you do such a great job at your annual letters and people have been reading them forever and you get to go on CNBC and nobody very rarely asks you difficult questions. So maybe he was asking for some penmanship favors to write this letter back to the administration, which I like this tongue in cheek. He says, Chevron will engage in this week's meeting with the Secretary Granholm. I encourage you to also send your senior advisors to this meeting so they too can engage in a robust conversation. Chevron shares your concerns over the higher prices that Americans are experiencing. And he says Chevron has increased capital expenditures, meaning money they're investing to get more oil, to $18 billion in 2022, which is 50% higher than last year. The reason I like this as a tongue-in-cheek thing is because the average person out there has full-time jobs and other lives outside of our full-time job here to study markets, Frank, but they can see through this. And what you want to do here is you want to have exposure to energy companies to fight back against the high inflation. That's the big takeaway here. Hopefully it's entertaining and all that, and we can get you to see that light or kind of make that connection. But that's the big takeaway here. You finally have oil company CEOs fighting back and standing up and saying, hey, this is what's going on. The problem for us in the short term is that prices aren't going down anytime soon because you can't bring on refining capacity at very much of a larger scale than now. So that's aggravating.
So I want you to forget politics for a second, which is very difficult to do. I want you to forget what side of the aisle you're on because it doesn't matter.
You talking to me or the audience?
I'm talking to everybody. Okay, because I know you're not going to do that. But I want you to forget what side of the aisle you're on. Now, the person coming in gets elected, and as he's campaigning, and a year or two before he gets elected, this is what he says, quoting, "We are going to get rid of fossil fuels. Okay, no more coal plants. We should put them in jail." When he was talking about fossil fuel executives, I'm quoting, "We should put them in jail. I'm endorsing a fracking ban when I get elected." Okay, this is whatever party you're from, this person is about to control, right? And they're going to control the entire government, right? All three branches. And this is what he's saying, and this is what he's doing. If you're an oil company, I'm not going to curse. I want to curse to get the emotions out of me. How the hell are you going to go, like you said, put pedal to the metal and make these massive, massive investments when you know that this person coming in is totally against your industry? Okay, how do you do that as a business, as someone who runs a business? And for Biden to say what he is saying right now, like, oh, I'm letting these guys drill and I'm opening up federal lands and all this shit, and all this investment, all this money they make, they're giving away in dividends and, with oil prices going higher and they're buying back stock. What the hell? What do you expect them to do? I mean, this is when you invest in these oil investments and invest in oil fields. I mean, this takes years of CapEx. A massive amount of money comes in and you're forcing people, and you have these asshole, and I hate to say this because it's in my industry and I won't even name them, but, the companies that own these massive ETFs have incredible voting power. And now you're forcing people who hate to drill on the board of ExxonMobil. I mean, what do you expect them to do, right? So, all this and to really be blaming the oil companies, again, it goes back to what I was saying earlier. You're looking at the people saying these people are a bunch of freaking idiots. Like they're going to believe anything I say. They're not going to do the research. They're not going to look into this. We're going to make this a Democrat Republic thing, and they're rich oil companies, and they screw everybody in the margins. And the funny thing is just the grandstanding that's been taking place from Biden and the Democrats. And I get it, it's ahead of midterm elections, right? So you're going to make a big deal, like calling out oil companies, how they should produce more, even though you did everything in your power to prevent that, to wean America off fossil fuels. You've been elected, going after the refiners and their margins. This, I think, is hilarious because the reason why their margins are so high, these refiners, is because the White House has sold 150 million barrels of from the strategic oil reserve, petroleum reserve. And that oil, I don't want to get too technical, but that oil is like really, really high quality oil. It's called medium sour. It's like oil from Russia and the Middle East. It's the best. So it doesn't require lots of refining. So when they're selling it, who the hell is buying it? Marathon and Valero is buying the shit out of that oil, meaning it's requiring less refining and they're increasing their margins. So now, because you're releasing out of strategic oil reserve, you're starting to attack the refiners because their margins are so high and how they're price gouging, everyone. Now, again, you're releasing that oil from the strategic petroleum reserve, which I find amazing, which, by the way, I mean, there's calls when it comes to this that by October, we're going to be at 40-year lows. 40-year lows. So, when you're looking at oil in general, when you're looking at strategic oil reserve and being depleted right now, what's going on? It's insane to me. I mean, it's going to be a low 358 million barrels by the end of October, right? It was 600 million to start the year. That's how much oil we released as oil reserve, right? Petroleum reserve. And when you look at that, how much is being depleted, I look at Russia and all the sanctions and everything we place. Russia right now is in a massive position of strength. Massive position of strength. They can go to U.S. and say, okay, here's what we're going to do. We're hearing a lot of, insiders are predicting that, the latest round and where they're taking over, after they take over a certain part, that there could be peace negotiations. They can go to all the countries right now. They can go to everybody. They can go all of Europe. They can go to the U.S. and just say, hey, we'll do the negotiations and we'll stop this war and we'll have a peace agreement if you buy 300 million barrels of oil for us at a certain price. We won't announce it publicly, right? Just like whatever, the Cuban Missile Crisis, all that shit. But they in such a position, and you're going to see food prices come down. You're going to see oil prices come down. And Russia, again, U.S. and Europe are still going to say Russia's the enemy, they're the worst ever. They're going to shit on them. They don't ever shit on China because everybody's getting paid, but they'll shit on Russia. And this is their opportunity. So I really think in the next couple of months, it's going to benefit Russia. It's going to benefit everyone if they're in that position to do that. We'll see. And a lot has to do with oil and food prices. And that could be a massive, massive catalyst for stocks. We'll see, because you can't continue at this rate where you just, throwing oil out there. They have no solutions. An 18-cent tax, like you said, is 3.5% tax. Yes, gas price is still going to be up 70% year over year, which is incredible, right? So, I mean, they were hovering around $3, and now what? They're going to be $4.80. And is that your solution? That's your but he has to say something because midterm elections are coming up.
Hey, so that's good though, because for every 10 gallons of gas you put in your car, that's $1.80 in savings.
Yeah, I know. And that's going to help you tremendously. But the thing that surprised me, and this is so we're talking about the general state of the industry, but the returns on oil stocks oil's down pretty close to $100, down 20% off its highs 2 weeks ago, 120. And the sell-off, like Pioneer, raising its dividend, it doesn't get better than that for companies like Pioneer. It went from 288 to 230, down 20%. Exxon was 105 3 weeks ago. It's 88. You look at Marathon was 33, it's 23. That's 30%. Halliburton, 43 to 31. That's a 30% decline. How do you own these oil stocks thinking, hey, I'm safe? And if you own them a while ago, you're fine. You fucking kicked ass on these things. But a lot of people have been coming in lately because they're looking at the dynamics of oil and saying it should be $150, going to go a lot higher in all these stocks, but necessarily that doesn't really translate into higher oil stocks. Now, if the commodity rises, it doesn't always look at gold. Gold has held steady, and trading near its all-time high. Well, I don't know where it is today, say 1900, close to 2000. I could tell you, if you're looking at gold stocks, they're down incredibly, right? So it doesn't always translate into that. It should translate into higher profits, but it's interesting to see this trend. I don't know why it's coming down. Is it because that they're going to be attacked? They're going to be taxed at a higher rate? Is it the recession and people, they think demand's going to fall off a cliff? But just to see these things really come back, they should be trading a lot higher for where oil prices are, even $100, which is incredible. So I'm just surprised to see that move.
And we'll have to, well, to your point, I mean, they had a massive run up higher. So there has to be, you can't fault anybody that's been in it for a while to have some profit taking. Oil did drop significantly. You have a lot of political headwinds. You have a lot of headlines that are trying their best to get down or to get the price of oil lower. And it has been. But now, so you're right, Frank. If you bought a month ago oil stocks, you're upset because you're down 20-some% on, like you said, what's supposed to be, well, it is a great industry. It's a great, quote unquote, safe haven for things like that. Now, what do? Well, you have to evaluate that personally, but the bigger picture there is because of the volatility you're going to have across the board. That's why you want to scale into positions over time here. I think that's the big takeaway. Yeah, if your thesis have changed on the oil companies and you're down 20%, that was your stop, sell and move to the sidelines and look again later. However, if your thesis hasn't changed and you're only down because the entire market is down, I would pay close attention and I would think before selling in that scenario. And I would, like I said, most people are buying month over month or every couple months as they get paid or they have some source of income. And I would definitely look to fill up those different buckets however you see fit, because other than the price and other than the headlines that you read, nothing has changed in the oil markets, and nothing will change for a long time unless policy changes. And the odds of that to happen are very, very low. So therefore, you don't get run over. You don't have to play in the industry and profit if you don't want to, but don't ignore that and the impacts that policies and things like that have on consumers. And I know we don't have time today, but next podcast, whenever that is, Frank, we'll talk about the similar situation in metals and everything else, because these are rinse and repeat recipes, and we want to be able to help notify those and help as many people as possible, benefit from that when they happen.
And as you were talking, I was just seeing, because I mean, they have moved up considerably, oil, but you have to, they also came down considerably, right? So you're saying, wow, they made a nice move to the upside. They have made a nice move to the upside. But when you compare markets and the margins are much greater now than they've ever been. They're drilling for much, much cheaper. But we compare to certain times when we're looking at, say 2014, right? So you had 2013, oil prices were pretty much 90 to 100. It went up to 107 in 2014. If you're looking at the XLE, which is one of the largest, oil ETFs, I think it's producers and drillers. I mean, stocks are still down 30% from those levels. And we're looking at 107. We're looking at where prices are today. So they're down considerably. Their margins are greater. They're generating more profits. And just to see this pullback, believing that oil prices are going to maintain these levels or go higher, it's just, for me, it's a big surprise. It really is a big surprise. I mean, it's just, it just tells you that when you're in a deleveraging process, even the good names might be sold off. Like Microsoft's been putting up great numbers. And they're down, 20% plus? I know you have the Facebooks and the Netflixes are down a lot more than that, 30% plus, 35% plus, maybe more than that. But you're going to see good names get hit when there's a deleveraging process taking place. And this is one of the areas where everyone was rushing into. But just to see that massive decline is interesting. And, everybody, and what scares me is not only is everyone bullish on energy, you won't find someone that's not bullish on energy, Daniel, but everyone and their mother has said, you got to buy this dip. And to me, being in the market for 30 years makes me a little nervous. I like when people, just like right now, the whole world is completely bearish. I'm picking away. I see stats that make a lot of sense, and I'm looking 2 years out. I don't know what the hell's going to happen in the next 6 months because it's so crazy, but I do know inflation is going to moderate considerably over the next 6 months and going forward, with just what the Fed's doing right now. And it will happen, especially if we can get something with, Russia and Ukraine to end. I think that'll be huge, right? With the bottleneck, with not just supply chain concerns, but the rising prices in food, which is more significant than energy. I mean, people are not going to have access to food soon. That's how high food prices are going to go based on the increase of fertilizer prices and stuff. And I covered that. But it is interesting in oil. It's a great argument of, should you start picking away? And what do you pick away at, Daniel? Because do you get more aggressive here? Because Exxon's down 20%, but yet the aggressive ones are down 40%. The average is down maybe 30%. So are you going, hey, now it gives me an opportunity to buy these, big cash cows that are going to pay me dividends and the Devons and stuff like that? Or, should I get more aggressive where it's going to give you a chance to really buy some of these aggressive names? But it seems like more of a market call than an individual stock call where everything got nailed in this industry.
Right. I I would make it very difficult. I would be boring with this. I think you can buy the big ones. If you want to look at some of the, like you've pointed out in the past, when the things that sell off hard, when things reverse, they typically go up the highest, and you can make a lot. With the new environment we're in, this new inflationary higher interest rate thing like that, I would keep it simple. I would buy, I've been talking about, and I'm still down on it a little bit in my account, but Berkshire Hathaway, I think, is one of the best stocks for inflation and inflationary times. You get a lot of exposure through other brands there, or businesses there like Chevron, but I really think that you could look across the sector. I know I heed your point on, and I could be wrong in the short term about, it is odd when the consensus, you're a part of the herd, because I'm bullish on energy like a lot of people have. I have been for some time. I just don't think that, even though you get a lot of people calling for it, yeah, we could see more sustained lower prices or whatever, but I just don't think just because a lot of people get bullish on it that trend has run its course. And I'm not saying you're saying the run is over. I say all that to say you can be boring and still make really good returns, I think, over the next year at least. So buy just like Dollar Stock Club, we put ExxonMobil in there because of the board members that you talked about earlier getting elected. And it's done very well, about a year. I think we put that in June of last year. And yeah, it's off from its all-time highs. But again, it's great to see a situation where if you only bought in the last month, you're down. Because a lot of those oil, year to date, you don't even have to capitalize on if you just bought at year to date, a lot of those companies are up tremendously, and you offset that with 30% declines in major market indices. I think that's great.
I think it's funny that you said Exxon. I'd stick with the boring companies. The boring company that's about to generate $400 billion in revenue. The boring company that's going to generate $44 billion in free cash flow. $44
billion in free cash flow?
In free cash flow.
Nice.
Which is up from $36 billion in 2021. That's projected this year. Just to put that in perspective, I mean, if I had to guess, that's probably $44 billion net free cash flow for Exxon. By the way, pays a 4% yield. It's trading at 8 times forward earnings, where the market's trading at 15 times forward earnings. Again, oil companies in general trade, 10, 12, so it is at a discount. But you're looking at $44 billion in free cash flow is probably a greater market cap than at least more than half the companies in the S&P 500. That's what they're generating in free cash flow. So you talk about a company that could literally buy the solar industry, the wind industry, all if they wanted to do all that stuff. All this massive amount of money that can go into drilling like crazy to help. But how are they supposed to, when we have an administration that's totally against it, and you said you're against it a year before you were running, and now that you're elected, year and a half in, almost 2 years in, and now you're yelling at these companies of why they're not drilling more, as someone who runs a company who you're obligated to your shareholders. How could you increase production in the U.S.? And it's kind of amazing, because you could say, well, how do you play this? And like you said, Daniel, you're looking at oil companies. Should we buy them this pullback? And for me, the best play on oil right now is to buy coal. Everyone's increasing coal right now. They're not allowed to say it, but if you look under the hood and you look at all these companies, and even you look in, especially in Europe, especially how much in China. I mean, the amount of production of coal across everything, and Europe's more of a consumer of coal, but you're seeing coal ramp up. You're going to see uranium ramp up. Let's ramp up these things. And you're seeing it because it's about profits and it's about money at the end of the day. And what are you seeing now, Dan? You're seeing less money go into ESG. A ton of money flowing out of it, going, holy shit, all these expectations. And now you have an administration that's kind of on its heels. All right, we said we weren't going to do fossil fuels, but now you see coal companies increasing coal usage and coal production, and you need that. And you just look at the profits. Look at some of these companies, guys. You can do your research. There's only about three publicly traded companies that you know of that you can look at. I don't want to say it because we have one of them in our portfolio that's done well, but to me, that's a play. Like if you're buying uranium with high natural gas prices and staying high, if you really think oil is going to go higher, you have these great oil companies, these totally boring, super boring oil companies trading at massive valuation, 4% yield, at cheap valuations, growing like crazy. It's not so boring when that stock in your portfolio that you like Snowflake, is down $250. What was it? Yeah. 400? It's 130, whatever it is today. But these things down 70-80%. Those boring companies are very, very good right now, and they're increasing profits, increasing cash flow. But let's see. I mean, with the headwinds coming in and everyone going against oil companies, it is going to be interesting. But man, a lot of stocks we mentioned, right? A lot we covered today.
Yeah, handful of oil companies. It's low hanging fruit out there. Just You don't need the bottom to start buying stocks, especially in energy, people.
And you're not going to know when the bottom is, guys. I mean, you'd like to buy at the absolute bottom and sell at the absolute top. And I know it's very difficult when you're watching, especially watching CNBC right now, about all the inflation and destroying. Inflation is going to continue. And the Fed just actually, Powell says we have no control over food and energy inflation. And everything you're looking at, you're like, holy shit, I should just, jump off a building. Before you do that, listen, you have to look at all the facts, like I said earlier. I mean, stocks are down incredibly. You're seeing some names down 70, 80%. A lot of companies are trading near the cash they have in their balance sheets. And you don't get an opportunity like this to buy a lot of these names. And it's going to be crazy. You got to hold your nose and just say, holy shit, and buy some of these things. But start picking away here, because if you have a 2-year time horizon. If you want to trade, you can trade back and forth. I mean, today the market opened down a ton, and now it's up as I'm watching, and we're about to finish this podcast at 11 a.m. So, trading's different, but if you have a 2-year time horizon, which many investors, I'm sure listeners to this podcast do, start picking away some of your favorite names, because you're getting them at 30-40% discount. Insiders are buying. They're cheaper than they've ever been. They still have good growth models. They're still growing earnings, but yet there's just so much uncertainty out there. That's when you're able to get stuff cheap, when there's uncertainty, when things are like, holy shit, I don't know what's going on. When things are great, you're not able to get these massive discounts. Now you are. That's why you should be picking away. I mean, that's the best advice I can give. Yeah,
I think that's great. I mean, nobody has a crystal ball. You want to scale in, you want to invest. I can't say that any better, Frank. Good job.
No,
we're good.
I appreciate that.
It's Wednesday. Everybody have a great Wednesday.
Have a great Wednesday. I will see you tomorrow, guys. I really appreciate you listening today. Questions, comments, we're here for you. Daniel, what's your email address?
Daniel@CurzioResearch.com.
And make sure you send him really nasty emails. He deserves them.
I've been getting nice ones lately, so yeah. And questions. And like I said, even though if I don't reply, I read them, and I'm working on getting back to a handful.
We got to get into politics. This way you get some of those negative emails.
Meh.
I love your strong opinions on politics. We're going to talk about politics.
Well, you were goading me. I was just about to say something really good.
We'll save that. We'll save that for the next podcast. But thanks, Dave, for coming on. I really appreciate it, buddy. And,
cheers.
Okay, guys, this is for me again. Questions, comments, Daniel, email me at frankcurzioresearch.com. And I'll see you guys tomorrow. Take care.